What's up, guys, and welcome back to my channel. So today I'm beginning with another video. So today we're going to be talking about forex market versus synthetic market. Right. So by the end of this video, you must be able to know the difference between the forex market and synthetic market, right? And which one is the best for you to use, or why you use both, or any other things that you might want to know, right? And if you've got any questions, leave them in the comment section down below, and I'll address them in the comment section, or what create a separate video, right? So let's jump into it. So the forex market stands for the foreign exchange. Forex stands for the foreign exchange, right? It is a trading currency pairs, i.e., that is currencies between what countries, right? So we'll be trading between what two countries, two currencies will be trading what against each other. Let's say for the I just use this common example, Euro USD. That's the most traded pair, if I'm not mistaken, right? So Euro USD will be saying the European dollar is trading against what the US dollar, right? So they will be the base and the code currency. I'm not going to talk about them much, but just know that there are two currencies that will be what trading against each other for which one will what more power, more what more value at that time, right? So then for the synthetic indices, these are the indices are the mimic of the real financial market, right? They are just a copy of the currency forex market, right? The financial market, right? So they are not real financial instruments. The copy of what financial market, a copy, right? They will be trading what the financial market, right? So it is the struggle between the bulls and the bears, right? The buyers and the sellers, right? In this case, the one with the most volume wins, right? So we're saying that, let's say, let me use the next slide to explain this, right? So we're saying that what the bulls and the bears are trading against what? Against each other, right? So some people are buying, let's say, Euro USD, right? EU, sorry, yeah, EU, right? So some people are buying and some people are selling, right? So the one with what? Let's say let's just say the one with the larger lot size wins, right? Where there are most people, where the larger money is, that side wins. So if more people are selling this what, selling this market, right, it will go down. And if more people are buying it, it will go up, right? So the side with the most volume wins, right? So whichever side is the most volume, the largest amount of money, right, will win, right? The market goes what in that direction, right? So let's take it for this one, for this example, right? So let's say we have got here we've got the bulls, right, and the bears over there, right? So the bulls, let's say the total lot size of the bulls, all the bulls in the world combined together, right? All the buyers in the world combined together, let's say it amounts to what? To $100 lot size, 100 lot size, right? And the bears, all the bears in the world combined together, their lot size amounts to what? To 50, right? So in this case, obviously the bulls will win. Why? Because they've got the larger volume, right? Most people, the most money is what in the bull side, so they will obviously win. They will have the power to push the market, right? If the lot size is if the volume is what almost equal, that's when the market will be what consolidating or all that stuff, right? It just shows that there's no volume in the market, right? So in this case, price ends up going on upwards because compared to the bearish momentum, the lot size of the bulls is larger, it's bigger, right? So in this case, the market ends up rallying on upwards, right? So we've understood how the forex market works, right? Let's now get into the synthetic market, right? So the synthetic market is a little bit tricky, right, to explain, right? So here the market direction is not determined by the highest volume of the buyers or sellers. Rather, the market moves as a result of the cryptographically secure random number generator, right? So we're just saying that it's just a code that is what already encrypted, right? So before anyone enters a trade or anything, right, the market will already know where it's going, right? So let's just say when I'm taking, for example, let's say just say boom 500 is supposed to be buying for the rest of the for the rest of the day, right? Even if everyone in the world sells boom 500, it will keep on going on upwards. Why? Because it has already been programmed to go upwards for that day or upwards for that period of time, right? So this market does not consider volume, right? Even if the larger volume is what, as long as if the market direction is already what, it's already biased to one side, right? There's no what changing it, even if there's larger volume, right? So right here, right, buyers and sellers not trade against each other, right? Right, rather they trade against the program, and the program determines what market direction. So as I was saying, right, even if the buyers and sellers, even if they've got the same volume, even if they combine together, even if they do whatever they do, right, the market direction is already what determined, right, by the program, by the program that has already been coded for long ago, right? So synthetic brokers that offer our indices, right? Do you know? Oh, sorry, let me just pause this. So synthetic brokers are said to not have access to manipulate the synthetic market, right? So the direction of the one, as long as the system generates the numbers randomly in a sequence, right? So let's just say Boom 500 is buying, right? Nobody has the power to change it, to change the trend of that market for the day. What has already been programmed is programmed forever. Nobody has the power to change it or alter with it or play around with it. So that's just it. No one has got the power. So in this diagram, right, you've got the buyers over here, the sellers over here, right? Both sides are trading against this program right here, right? And this program is the one that determines the market direction. So it doesn't matter which side the buyers or the sellers has got larger volume. All that matters is where the program is going, where the market direction is going, right? So what are the differences between Forex and indices, right? Forex is regulated, right? Unlike the indices, right? So Forex is regulated by the Financial Industry Regulatory Authority, right? Or what they FINRA, right? Whatever it is, right? So the Forex market is regulated through the NC does not it has got some certain patterns that it follows, right? Unlike the indices, right? Then for the Forex market, you can only trade for Monday to Friday, right? Except if you're trading maybe a crypto or something. But for the Forex space that I'm discussing right now, you only trade from Monday to Friday. No extended, no weekend trading, right? But for the indices, you can trade even on weekends. So if you've got, let's say you go to work and you're busy during the week, you can always trade the indices. And if you want to open an account with of indices, trading indices, I've got a link in the description down below. Just click that link and it will direct you to the broker that offers the best indices, right? So the forex market is affected by news, right? So you have to keep on being updated about what is happening in the economic world, or any news that will affect the market. Any news that affects the country as a whole affects the market prices, right? Affects the price of the market, right? Unlike indices, they are not affected by any news, by any holidays, even if it's Christmas or anything. Even if the volume of the forex market drops, the indices do not get affected by all that stuff, right? It's just trading, no other, just your strategy, no other requirements needed for you to no other need no need for you to know the news or anything like that, right? Then for the forex market, is controlled by the banks. When I'm saying controlled, I mean the people that have the ability to move the market are the banks, right? If because they've got the larger volume, the banks have got the most money, unlike us retail traders, right? Banks have got more money, so they've got the potential, they've got the power, they've got the money to move the market. Unlike you just have to go in line with the trend of the central banks, right? And for the indices, it is controlled by the algorithm. As I said, it is controlled by a program that is already set, and you cannot change it, right? What is the importance of this information, right? So that you know that the indices aren't as manipulated as you think, because the program is already set. There's nobody who can change it. Just have to have a strategy that works, and you have to trade. You can cater for risk management, right? That's it. And for you to know what suits you best, as I said, if you're a person who goes to work, you can always open a indices account so that you can trade during the weekends. And if you're at home all day, or if you've got the time to read the news, to trade all day during the week, right, you can trade both, or you can just trade the forex market, right? So if you want to trade, and the broker that I use offers both forex and indices, you just have to differentiate between the MT5 accounts. So if you want to open an account, sign up in the description down below. The minimum deposit is $10, right? So that's it for this video. Like, subscribe, and share the content.